Good day. My name is Michael Bendner, and these comments are for the Finance Committee and the Ways and Means Committee for the hearings with Secretary Yellen on the Treasury Department's fiscal year 2023 budget held on the 7th and the 8th of June. We are quite sure that there will be questions from the minority about the national debt. I have a question for the Secretary and minority members and senators. Who benefits from the national debt, both public and private? Who is on the hook for paying it back? Does the question of debt as a percentage of GDP have any relevance? Anyone familiar with our work at the Center for Fiscal Equity knows that we have a few possible answers to these questions. In reverse order, debt as a percentage of GDP is meaningless. The more salient measure is debt as a multiple of income taxes paid. Using this standard shows exactly how unsustainable our current fiscal course is. We have attached a one-page summary regarding debt ownership as class welfare, which addresses the other two questions, and I will link to a talk about that in the description in the summary. Now we have the key findings of our research is that the top 10% own the majority of public debt assets and owe the majority of debt obligations. The top 1% owe over a third and own more than 40%. In short, those who pay and those who owe are the same people. Capitalists. Without the national debt, leveraging private banking, debt, and investment, especially the intrinsically worthless assets in secondary markets, is impossible. We are all for ending the national debt, along with capitalism as we know it today. Capitalism is about to drive the nation into ruin again. The pandemic provided a temporary reprieve as the Federal Reserve propped up bondholders who have invested, again, in bad housing and commercial property debt. Subsidies to families and loan purchases by the Federal Reserve delayed the pain. However, the pain is inevitable. Please see the second attachment, Depression 2022. There's also a talk that I'm linking to in the chat. And please refer to the Secretary and ask her to respond to it in your post-hearing questions. I would hope that these scenarios are already on the radar of the Assistant Secretary for Economic Affairs. The most important question for the Secretary to face is whether there was a reaction via correspondence or phone calls from families who finally received an adequate child tax credit under the American Rescue Plan Act and then had it taken away at the end of last year because of the bipartisan obstruction against continuing to do so. Yes, I said bipartisan obstruction. Some of the bipartisan opposition in the Senate came from those who considered direct subsidies from the IRS to have the stink of welfare. I advise such senators in both parties to raise the minimum wage so that no one is having to work just to receive this credit, and that the best way to distribute the credit is with wages. For middle-income taxpayers whose increased credits are less than their annual tax obligation, a simple change in withholding tables is adequate. Procedures are already in place to deliver refundable credits to large families. So this would just apply it to one or two child households. Employers can work with their bankers to increase funds for payroll throughout the year while requiring less money for their quarterly tax payments or estimated taxes to the IRS. The main issue is working out those situations where employers owe less than they pay out. This is especially true for labor-intensive industries and even more so for low-wage employers. A higher minimum wage would make negative quarterly tax bills less likely. Indeed, no one should have to subsist mainly on their child tax payments. While we hope that in the short term, obstruction on increasing the child tax credit can be dealt with, going forward, now that the American Rescue Plan Act has expired, any permanent increase to and refundability of the child tax credit, and ideally an even more generous credit, will require permanent tax reform. We include our prescription for such reforms at our third attachment. And you should probably be well aware of that by now if you are a member of either one of these committees. One of the central proposals of this plan is the creation of a subtraction value-added tax, also known as a net business receipts tax, which will replace the corporate income tax and filing of business taxes as part of the personal income tax. The difference between changing quarterly withholding and enacting a subtraction VAT is 6 of one and half dozen of the other. The reason for this is that the proposed subtraction VAT is based on the notion that employers would be responsible for paying and reconciling the taxes now filed by employees. This would add little additional burden to employers, especially self-employed, but end the burden of filling out taxes for all but the highest salaried employees. Debates on the child tax credit have used $75,000 as a benchmark. The debate has gone on so long that the numbers have changed. What used to be proposed at $75,000 per year should now be delivered at $85,000 a year. Likewise, economic reports, particularly by the IRS Statistics on Income group, should be shifted to reflect this reality. Between $50,000 and $100,000, there should be 5 groups. Between $100,000 and $200,000 in these reports, there should be at least 4, so that the border between the 4th and 5th quintiles in the economy can be more adequately expressed. Every tax wonk in the nation will appreciate this. Our second major proposal is the creation of an asset value-added tax. There are 2 debates in tax policy: how we tax salaries and how we tax assets. That's returns, gains, and inheritances. Shoving too much into the personal income tax mainly benefits the wealthy because it subsidizes losses by allowing investors not to pay taxes on higher salaries with malice aforethought. Meaning, if they're getting too much money, they just throw in some losses. We all know a certain businessman from New York who used to do that on a regular basis, and this is why the Chairman Neal wants his taxes. So there really is a significant policy reason for getting them. So with tax subsidies for families shifted to employer-based subtraction value-added taxes, and the creation of an asset VAT, taxes on salaries could be filed by employers without most employees having to file an individual return. It is time to tax transactions, not people. The tax on capital gains is seen as unfair because it is lower than the rate for labor. This is technically true, however, it is only the richest taxpayers who face a marginal rate problem. For most households, the marginal rate for wages is less than that for capital gains. Higher income workers are, as the saying goes, crying all the way to the bank. In late 2017, tax rates for corporations and pass-through income were reduced, generally to capital gains and capital income levels. This is only fair and may or may not be just. The field of battle has narrowed between the parties. The current marginal and capital rates are working as a center point. It is almost as if the recent tax law was based on negotiations, even as argument flared publicly. Of course, that would never happen in Washington. No, never. No tacit compromises here. Compromise on rates makes compromise on form possible. If the Peace and Affordable Care Act provisions are repealed, a rate of 26% is a good stopping point for pass-through, corporate, capital gains, and capital income rates. A single rate also makes conversion from self-reporting to automatic collection through an asset value-added tax levied at the point of sale or distribution possible. This would be both just and fair, although absolute fairness is absolute unfairness to tax lawyers, at least, because there would be no little room to argue about what is due and when. Ending the machinery of self-reporting also puts an end to the quixotic campaign to enact a wealth tax. To replace revenues lost due to ending of the personal income tax for all but the wealthiest workers and celebrities, enact a goods and service tax. A goods and services tax. A GST is inescapable. Those escapees who are of most concern are not waiters or those who receive refundable tax subsidies. It is those who use tax loopholes and borrowing against their paper wealth to avoid paying taxes while still spending money. For example, if an unnamed billionaire or billionaires borrow against their wealth to go into space, creating such assets would be taxable under an asset value-added tax. When the masters of the universe on Wall Street borrow against their assets to avoid taxation, having to pay a consumption tax on their spending ends the tax advantage of gaming the system. This also applies to inheritors. No death tax is necessary beyond marking the sale of inherited assets to market value at sale, with sales to qualified ESOPs tax-free. Those who inherit large cash fortunes will pay the GST when they spend the money, or the asset VAT when they invest it. No special estate tax is required, and no life insurance policy or retirement account inheritance rules will be of any use in tax avoidance. Tax avoidance is a myth sold by insurance and investment brokers. In reality, explicit and implicit value-added taxes are already in force. Individuals and firms that collect retail sales taxes receive a rebate for taxes paid on their federal income taxes. Tax withheld by employers for the income and payroll taxes of their labor force is an implicit VAT. A goods and services tax simply makes these taxes visible. Let me say this again. If you are a retailer and you have to collect a sales tax, then you can take that tax off of your what you've paid in that tax off of your federal return. So it's an intergovernmental VAT. So should the tax reform proposed here pass, there is no need for an IRS to exist. Safe to do data matching integrity. States and the Customs Service will collect credit invoice taxes. States will collect subtraction VAT, and the SEC will collect the asset VAT, and the Bureau of Public Debt will collect income taxes or sell tax prepayment bonds. There's the last attachment and the video have more on this. So yes, now before this happens, the question to the Secretary is if her analytical budget is big enough to consider such options as these. So, there's hope that there are enough people on staff to look at all this stuff. And you maybe have to add a few because it's, if you want to explore this stuff, it's a heavy lift and you should explore it. In which case, Madam Secretary needs more people to do the exploring because it will add a few more analytical staff members because the TCJA is going away anyway on schedule. So there's a lot to be talk about in the tax reform era. It's not going to be the easy thing that people think it is. It's not going quietly into the night, and we can't avoid it. So let's make sure the Secretary is funded so that we can then close the IRS if we pass this bill, this plan. Thank you very much. Have a pleasant day. And remember, if for those of you who are not federal employees, officers, senators, congressmen, staff, you know what to do about the comments and the Patreon and the subscription. We could always use your help. And in fact, if you're staff and you want to make comments, feel free. Want to make real news? Put your name down. Thanks very much. Have a pleasant day.